The S&P TSX Composite closed above 350 points higher on Iran war resolution hopes. Yet the stocks that drove this market's biggest year-to-date gains were the ones that fell hardest on the same news. Cenovus Energy had surged nearly 84% in 2026 on Strait of Hormuz risk premium. When that premium deflates, the capital that priced in disruption has nowhere to hide inside the energy trade. Canadian Natural Resources, up 44% this year and yielding 3.7%, slid alongside Athabasca Oil and Strathcona, all on a day the broad market celebrated. The disconnect matters, because it is not random. These stocks were not collateral damage. Institutional positioning in Canadian oil sands had been built on a specific thesis: that Iran-linked supply disruption would sustain crude above levels where integrated producers like Cenovus could maintain their Q1 2026 free funds flow of $2.2 billion per quarter. A peace signal dismantles that thesis in one session. What the price action shows, interpreted from volume alone since intraday flow data is unavailable, is that sellers were concentrated in the large-cap energy names CNQ, CVE, ATH, while broad market buyers absorbed the Iran relief into materials and industrials. Cenovus's situation sharpens the structural question. The company achieved its highest-ever quarterly upstream production in Q1 2026 to 972,100 barrels per day, and approved a 10% dividend increase. Those fundamentals did not change on May 26. The stock fell anyway, which means the repricing is not about the company's output but about the forward price of that output. When one geopolitical event accounts for 84% of a stock's annual return, the correction does not require bad earnings. It only requires the geopolitical condition to look less permanent. Canadian energy producers' collective gain of 46% in 2026 was built on a risk premium that is now being asked to justify itself on fundamentals alone. The mechanism deepening here is one that the energy trade's collapse forces into view. The same Iran peace signal that compressed oil prices is pushing rate hike probability higher, not lower. WTI falling toward $90 has not changed the market's rate outlook. The 60% rate hike probability cited by TradingKey reflects sticky inflation that energy price relief alone cannot resolve. That creates a specific problem for income-seeking capital that had been sheltering in Canadian energy dividends as a proxy for both yield and inflation protection. Brookfield Infrastructure Partners, yielding 4.6% and posting 10% funds from operations growth in its latest quarter, is the cleaner repositioning destination under this scenario. Its earnings are driven by cost of service contracts, not commodity prices, which means its cash flow does not deflate when crude slides. Enbridge, yielding in the high 6% range on long-term fixed-fee contracts covering North America's largest pipeline network, sits in the same position. The capital flow signal, interpreted from price action rather than disclosed net flow data, suggests income-oriented holders were shifting from oil price-sensitive dividend names toward contracted infrastructure during the session. The position pressure change upstream of that flow is straightforward. A holder running Canadian energy exposure as both an inflation hedge and a yield trade loses both legs when crude falls and rate hike odds stay elevated simultaneously. The inflation hedge premium deflates, while the yield advantage narrows against the higher risk-free rate. TELUS, yielding 9.7% inside many TFSA portfolios, introduces the complication. Its dividend sustainability is already under structural pressure. The company is paying 112% of free cash flow as distributions, with debt at 3.5 times adjusted EBITDA. A rate environment that stays higher for longer does not benefit TELUS. It raises the cost of the debt the company is trying to reduce. Income-seeking retail capital that moved into TELUS for its yield alone is holding a position that tightens in the exact environment where pipeline and infrastructure names widen. The question the energy trade's collapse forces is not just where oil goes. It is whether the income capital that rode oil higher has correctly identified its next harbor, or whether it is rotating into a second mispricing. Canadian National Railway completes the picture by exposing the frame that neither the energy trade nor the income rotation fully addresses. CNR is down 12% from its 2024 peak despite a 16% gain in 2026, and management's 2026 guidance is roughly flat with 2025. The year U.S. tariffs cost the railway $350 million in operating impact. That gap between a record TSX and a structurally pressured rail backbone is the day's unresolved question, because CNR moves what the TSX's commodity sectors produce. The CUSMA renegotiation timeline is the decisive variable. CNR's cross-border volumes, grain, coal, fertilizer, energy commodities, depend on the Canada-U.S. trade framework that is unlikely to resolve before July 1st and may extend well into the summer. The proposed Union Pacific-Norfolk Southern merger in the United States adds a second layer. If that deal clears regulatory review, Canadian National's Gulf Coast routing competes against a consolidated American rail network covering 100 ports from coast to coast. Management responded by buying back stock and raising the dividend for the 30th consecutive year, signals of operational confidence, not of resolved competitive exposure. The income rotation frame from Chapter 2 does not reach CNR. Infrastructure buyers repositioning from energy into contracted utilities are not building CNR exposure, because CNR's forward earnings are conditional on political outcomes rather than contracted rates. Patient buyers who moved into CNR this year on CUSMA optimism are holding a position whose timeline is determined by negotiation, not by the commodity cycle or the interest rate path. The verification benchmark is the CUSMA negotiation outcome, expected before or after July 1st. If the framework remains unresolved past that date while CNR's cross-border volumes continue to show tariff drag in the Q2 2026 report, due in late July, the gap between the record TSX and CNR's relative underperformance widens further. The position does not break unless CUSMA resolves and cross-border volumes recover simultaneously. Event completion alone, without sustained volume recovery, would not reestablish the prior earnings trajectory. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.